Welcome to the Prompt Perspective. This is the channel where we break down global conflicts, financial markets, and the hidden forces shaping your money. Make sure to like the video, subscribe to the channel, and turn on notifications. Today's topic is Israel-Iran War Update. Is your money safe? Because when wars escalate in the Middle East, the impact rarely stays regional. It hits oil markets, global supply chains, stock markets, and sometimes your investments. The Israel-Iran conflict is not just a military confrontation. It sits at the center of one of the most strategically important regions in the world. The Middle East produces roughly 1/3 of global oil supply. Any escalation raises fears about disruption to key energy routes, like the Strait of Hormuz, through which about 20% of the world's oil passes. If that route is threatened, oil prices can spike quickly, pushing global inflation higher and creating uncertainty across financial markets. Immediate market reactions. Historically, geopolitical shocks create predictable market reactions. Three things usually happen first. Oil prices jump. Stock markets become volatile. Investors move towards safe assets. We've seen this pattern during major conflicts, like the Gulf War, the Russia-Ukraine War, and earlier Middle East crises. Markets hate uncertainty more than bad news. And geopolitical escalation creates exactly that. Which assets usually rise during war? During global tensions, certain assets tend to perform better. Gold often rises because investors treat it as a store of value. Oil companies may benefit from higher energy prices. Defense stocks can also surge when governments increase military spending. Meanwhile, sectors that depend heavily on global trade, like airlines or manufacturing, often face pressure due to rising fuel costs. What happens to stock markets? The broader stock market reaction depends on how large the conflict becomes. Short-term shocks are common, but historically, global markets tend to recover unless the conflict spreads into a wider regional war. For example, during many past geopolitical crises, markets dropped sharply at first, but stabilized within weeks once the situation became clearer. The key variable is duration and escalation. Safe haven strategies investors watch. During geopolitical uncertainty, investors often rebalance toward assets perceived as safer. These can include gold, U.S. Treasury bonds, the U.S. dollar, energy stocks, diversified global funds. But it's important to remember, no investment is completely risk-free. The goal in volatile times is usually diversification, not prediction. The bigger geopolitical picture. The Israel-Iran tension also intersects with global power dynamics. The United States remains a key ally of Israel. Iran maintains relationships with various regional groups and has strategic ties with countries like Russia and China. Because of these connections, any escalation has the potential to ripple across global politics and markets. This is why investors and governments monitor the situation closely. Final insight. History shows that wars can create short-term financial shocks, but the long-term outcome depends on scale. If tensions remain contained, markets usually adapt. If the conflict spreads across the region, the economic consequences could be far larger, especially through energy prices and global inflation. So the real question isn't just whether a conflict exists, it's how far it spreads. So here's the key question for investors. Is this just another geopolitical shock markets will absorb, or the beginning of a larger regional crisis? Comment below with your perspective. If you found this analysis valuable, like the video, subscribe to the Prompt Perspective, and stay tuned for more breakdowns of global events and their impact on your money. Until next time, stay informed, stay analytical, and always follow the incentives behind the headlines.